As of August 6, 2026, the U.S. stock market is currently closed, and Tesla stock, NASDAQ TSLA, ended its last official regular trading session at a closing price of $321.55, reflecting a decline of $5.80 per share, or 1.77%, with subsequent after-hours trading holding stable around the $321.50 mark. While retail chatter across social media channels remains fixated on whether vehicle delivery numbers will rebound or whether price cuts in international markets will further compress margins, institutional desks are quietly positioning around an entirely different vector. The surface-level narrative surrounding Tesla stock suggests that auto manufacturing cyclicality dictates its ultimate valuation. However, the reality unfolding across order books and options chains reveals that Wall Street is pricing Tesla stock less like an automotive manufacturer and far more like an infrastructure utility for physical artificial intelligence and autonomous transport. This fundamental disconnect between retail expectation and institutional reality creates one of the most compelling setups in modern market history. When retail traders scroll through their favorite Robinhood app or log into their Fidelity trading platform, the common consensus is that Tesla stock hinges almost exclusively on quarterly electric vehicle deliveries and gross margins. The mainstream belief states that as competition intensifies from legacy automakers and foreign electric vehicle producers, Tesla stock must inevitably suffer valuation compression, pulling its elevated price-to-earnings ratio back down toward traditional automotive multiples. That is the expectation. The reality, however, is that institutional allocators managing vast pools of capital through individual brokerage accounts, Fidelity Wealth Management, and automated platforms like Schwab Intelligent Portfolios are evaluating Tesla stock through a completely different financial lens. They are looking at energy storage expansion, full self-driving network deployment, and the monetization of autonomous compute capacity. Examining the recent price action of Tesla stock offers critical clues into this ongoing tug-of-war. Over the recent trading sessions, Tesla stock traded between an intraday low of $320.28 and a high of $327.14, with daily trading volume hitting roughly 27.8 million shares. This volume sits somewhat below the 3-month daily average of 46.4 million shares, signaling a period of institutional consolidation rather than aggressive distribution. When an asset with a market capitalization exceeding $1 trillion trades on lighter volume while holding key technical support levels near $320, it indicates that long-term holders using self-investing strategies or managed SoFi Invest accounts are refusing to liquidate their positions despite negative headlines. Options flow data monitored on the Interactive Brokers platform shows significant block activity in long-dated call options. This suggests that sophisticated players using Interactive Brokers trading tools are accumulating upside exposure, while short-term retail traders panic over temporary quarter-over-quarter delivery fluctuations. Macroeconomic pressures, including interest rate expectations and broader technology sector volatility, have certainly created headwinds across all major growth equities, affecting everything from Apple stock and Nvidia stock to broader index components. Yet Tesla stock has demonstrated notable resilience, bouncing off its 52-week low of $397.38 and maintaining a trajectory that keeps its long-term structural narrative intact. To fully understand why this expectation versus reality dynamic exists, one must look at what the business actually does versus what the general public perceives it does. At its core, Tesla designs, manufactures, and sells electric vehicles, energy storage systems, and solar panel installations, while developing software and hardware architectures for full autonomy and humanoid robotics. For years, the automotive division generated the vast majority of top-line revenue, leading traditional analysts to categorize Tesla stock alongside century-old car companies. Past financial reports show how vehicle sales powered the balance sheet, building a massive cash reserve that now allows the firm to self-fund capital expenditures without taking on expensive debt. But while historical income statements reflect a business reliant on car sales, current operational realities show the energy storage segment growing at a dramatically faster percentage rate, carrying higher gross margins and providing a massive recurring revenue buffer. This divergence between past performance and present execution is precisely where retail investors get caught off guard. Investors using Robinhood stock trading or checking SoFi stocks often react to quarter-over-quarter delivery misses, assuming the primary growth engine has stalled. Meanwhile, investors utilizing Fidelity brokerage services, SoFi robo-advisor algorithms, or Interactive Brokers analytics recognize that energy deployments and software licensing potential represent a structural shift in cash flow quality. The market narrative expects slow, linear growth driven by factory build-outs. The reality is an exponential expansion driven by software margins and grid-scale energy storage assets. Looking ahead, the future outlook for Tesla stock depends on several critical catalysts that could dramatically widen or narrow this expectation gap. If autonomous taxi networks gain regulatory approval and commercial deployment scales across major metropolitan areas, the cash flow generation could redefine how analysts value the asset. Under this bullish scenario, Tesla stock would transition from being priced on vehicle units to being priced on miles driven and software subscriptions, similar to high-margin tech platforms. Conversely, the key risks involve extended regulatory hurdles, delays in next-generation hardware manufacturing, or persistent high interest rates that make vehicle financing more expensive for everyday consumers. Should those risks materialize, the market could temporarily punish Tesla stock, dragging it back toward its lower valuation bounds and testing the conviction of self-investing market participants. Comment below how many shares of Tesla stock you currently hold in your portfolio and whether you are buying this current level or waiting for a deeper pullback. When you look at the broader landscape of modern online investing, navigating the volatility of high-beta assets requires a clear framework. Whether an investor chooses to trade through Robinhood Investments, execute complex options orders on Interactive Brokers stock trading, accumulate Fidelity ETFs, or rely on automated rebalancing via Schwab Intelligent Portfolios, understanding the difference between headline noise and structural value is essential. Tesla stock continues to serve as the ultimate battleground asset where retail sentiment often clashes directly with institutional positioning. In summary, the central tension surrounding Tesla stock remains the sharp contrast between market expectations and operational reality. While surface-level sentiment focuses heavily on vehicle manufacturing metrics and short-term price adjustments, institutional capital is focused on the rapid growth of energy storage, compute infrastructure, and autonomous software capabilities. With the stock closing at $321.55 after an intraday range of $320.28 to $327.14, the underlying metrics suggest that the long-term structural story remains far deeper and more complex than daily headlines imply. Understanding this balance between temporary headline friction and long-term asset value allows disciplined investors to see past short-term noise and evaluate Tesla stock with absolute clarity.